So I need to remind you before we begin this topic that this is a BUSS2 topic. So remember, this is when you're managing your business, you've been in business for a while, your business is larger, you'll possibly have some people working for you, you'll have some employees, so consider that. So when we look at using budgets, we've already identified that there'll be an income budget, an expenditure budget and a profit budget, and it's likely that that'll be delegated to managers. And so we need to think again about the benefits and drawbacks, so that'll be building on our knowledge. But then we actually need to use some numerical calculations in order to help us make informed decisions. So we need to consider, what are the benefits of using budgets? Remember that these will apply to all businesses, but you must look at the case study and see if there's going to be any application there, something that will help you build this in and consider the impact. So it provides direction and coordination. So it gives a focus. If it's a manager who maybe hasn't got an awful lot of experience, they'll be able to pull together, and that's particularly important if you've got more than one retail premises, or perhaps you've got a production bit of the business and you've got a selling bit of the business, and it'll ensure that it links together with the objectives of the business and give key focus. It can motivate staff. You've got to link to Mayo and Hertzberg here, so you might not have covered those so far, but you could see with those that individuals will be encouraged by the responsibility. They'll like the recognition that they meet the deadline, that they're satisfying for people above them, that they can aim for a target and take not just themselves but perhaps the whole of their little team with them in order to achieve the objective. You need to consider, though, it might not motivate the staff if the budget hasn't been prepared realistically. It should improve efficiency, so the idea is that you'll have a target to meet. If it's an income budget, you'll have, we would like this amount of income from sales, and it might be of goods, and we might have this amount of income from sales of services, and it can be over a period of time so that you can plan for seasonalities. And similarly with costs, and so it actually makes the managers, if they haven't met the target, it makes them want to investigate why not, and therefore they can improve in the future. Then they can assess forecasting ability. So let's say, for instance, there will be some things, costs that are unplanned for. If your vehicles break down or if a piece of machinery is broken, you can't perhaps foresee those things, but there will be some things that you can plan for in the future, and you can see how it affects the income or how it affects the revenue or how it affects the profitability that you have budgeted for. So if we look at some of the drawbacks of using budgets, then they're difficult to monitor fairly. People who are in senior management positions really probably won't have a very detailed grasp of the revenues and costs of each functional area of the business. And so really they depend on the budget holder to be truthful, to assess these things and to pass on the information so that it can be used well. So it really depends upon whether or not the budget holder passes the information and it's assessed correctly. Allocations may be incorrect. So let's say, for instance, I give you an insufficient cost budget, so that you miss out on marketing opportunities, or you miss out on paying your staff bonuses because they aren't allocated correctly. I think that'll be really demotivating for your staff, knowing that really they want to do something and they aren't able to because it hasn't been budgeted for. Similarly, if I said to you that you were quite a niche market business, your target market was quite narrow, and I suggest that you have a revenue budget of X number of pounds, you might just shake your head in disbelief and think, I'm never going to get there. And so it doesn't give you any impetus in order to try and meet the budget target. Savings may be sought that are not in the interest of the firm. So let's say, for instance, I'm given what I think is an inaccurate cost allocation. So I might have X number of pounds to spend on the raw materials, and the only way that I'm going to stay in that target is to buy poor quality or perhaps raw materials with imperfect features. And so you can imagine how your customers would feel about that, getting raw materials that they think are maybe not up to past quality. And so actually, by making the savings, your revenue budget might be implicated because customers might just decide not to purchase your product anymore. Changes may not be allowed for when a budget is reviewed. There will be external factors that you can't possibly consider. So let's say, for instance, if you were an airline, after 9/11, you would have had to make significant changes to your business operations, the security. Now, if your budget it's a plan for the future, if your budget isn't due for review, how on earth do you try and put in place these changes? If I had to try and pick what a good budget should be, so look for these clues and you'll be able to assess whether or not the budget holder has been given a good budget to target for. So be consistent with the aims of the business. If your aim of the business is to provide a high quality service or to provide a high quality product, then your business needs the cost budget in order to meet these targets. It should be based on the opinions of many people. Remember, I've said in the past, management might come into this business with no actual knowledge, a working knowledge of what the business does on the shop floor, on the retail floor. And so it's important not just to give a budget holder targets, but actually to have them involved. You need to set challenging but realistic targets. So you might think, we'll take the budgets from last year. We could increase them by 1 or 2% for sales revenue, and we could decrease the cost budget by 1 or 2%. But realistically, you need to look at what the marketplace is doing and what your competitors are doing. You should monitor them at regular intervals. So we're going to do an activity that follows this, that says once something's happened, you should go back to it and you should review it with what happens. So you could do this on a monthly basis, you could do it on a 6-monthly basis. Again, consider the business. I think it's important to be flexible. So if there's a need for marketing because you've had some adverse publicity, that should be built in and there should be a budget in the expenditure budget for that. How are we going to use budgets as a monitoring tool? So this idea that I'm going to check and review and make some changes. So this is a slightly different slant to this. So we're going to use something called Variance Analysis. So we're going to compare what actually happens with the budgeted amount, and then we're going to look at if there's a difference. We will look for reasons, because obviously that will give us something to improve upon, or it might be something that we don't want to happen in the future. To talk you through an example then, so this is for the expenditure budget. So I've got a business here, they allocate £1,000 for stationery expenses. So you can imagine when you send out your invoices, you need these things. Your workers might need pens, pencils, you might need notepads, that kind of thing. The actual amount spent is £1,200. So the calculation I said was you should compare what you budgeted with and the actual amount. So we budgeted 100, we actually spent £1,200. My apologies, we budgeted 1,000 and we actually spent £1,200. So that was £200 that we spent more than what our budgeted amount is. So I've introduced a term here and I've said that this is going to be an adverse budget amount. So the question we're going to ask ourselves for expenditure budgets are, I have planned to spend 1,000. I actually spent £1,200. Is that more? And therefore I've spent more, it's bad for my business, it's adverse, or have I spent less, in which case that would be good for my business and it would be favourable. So our example here, I actually spent more, that's bad for my business and so is adverse. Okay, so just to recap what I said then, so negative variance for an expenditure budget is an adverse variance, so that's when you spend too much. And just because I've realised this, I have a typing mistake here. Okay, so while a negative variance for an expenditure budget is a favourable variance. So that means I didn't need to spend as much. Okay, so here's revenue. I've called it income. An income budget targets sales income of 65,000. So that's your budgeted amount. But the actual amount is 64,000. So my calculation, I take the budgeted amount, 65,000, and minus the actual amount. So I need to ask myself the question. Budgeted for 65,000 and I only received 64,000. So is this more? That would be good for my business. It would be favourable. Or is this worse for my business? It would be bad for my business and adverse. So I actually, in this example, received £1,000 less than what I planned for, and so it's adverse. Okay, so I'm looking at this slide and I can see that I was obviously in a different world when I wrote this slide. And so the word that you must bear in mind is revenue, because we've just used an income budget or a revenue budget. You can call it either of those things. So a positive variance for a revenue budget or an income budget is favourable. That means I made more sales than what I'd anticipated, while a negative variance for an income budget is an adverse variance. So we can also look at this for profit, because we had a cost budget, an expenditure budget, we had an income budget, a revenue budget, and now you could also have a profit budget. So just to help you then, adverse variances means less profit than expected. So we're talking about the profit here. I'm going to make you two suggestions why there might be an adverse variance for profit. It might be that costs were higher than budgeted, or sales revenues may be lower. In opposition to that then, if you made more profit and that would result in a favourable variance, it might be because costs were lower than what you had budgeted, or sales revenue may be higher. So when we look at some of the clues in the case study, these are some of the things that you might consider. So why might you get a favourable income variance? It might have been because you were able to charge a higher price. If one of your competitors has gone out of business, then customers would have needed somewhere to go and you could be the alternative, in which case you can benefit from a higher price because there's no competition or very limited competition. It might be that there's been an increase in demand due to a marketing campaign. So let's say, for instance, when they start selling some of these, the PlayStations and the Xbox, as soon as a new upgraded product becomes available, there's a lot of hype, you do some marketing beforehand, and because you know that there's going to be limited supply, customers are willing to pay a bit more, and so you can charge them a little bit higher. It might be because customers have said that they would like a higher quality, and so you run a campaign showing that the quality has improved, and as a result, more people buy your product, or perhaps they pay a higher price. We all know that as consumer incomes rise, they will perhaps switch to a higher cost product. So if you think about, they might move from a basic range to a everyday range, or it might be that they move from an everyday range to the speciality range, and that will cause fluctuations in the income. And maybe there's a change in consumer tastes in favour of your product. So, I don't know, there might be Christmas programmes on the TV, Kirsty's Christmas Goods, that usually has a peak in pinking shears. Or it might be that the MasterChef's on and everybody creates a product, and so loads of people download the recipes, and so they buy more of your ingredients. Okay, so as a business manager, I might also want to look at the adverse cost variances, because there would be things that I think, well, this is eating into my profit, and perhaps need to find reasons so that if I can plan for it if it happens in the future again. So let's look at the reasons. So I think it might be because production was higher. So let's say, for instance, I advertise my product, I have a marketing campaign going on, and demand is really high for my product. I'm not going to say, sorry, I've met my cost target. I'm going to obviously try and satisfy customer demand, and that means I might need to make more products, which will obviously incur extra costs. I might find that suppliers have raised their prices. So for as much as I might look at changing my prices, suppliers will also do that depending on how much we demand of their product. There could be inefficiencies in production. So I might have bought a poorer quality raw material, and it might have imperfections, and so I might find that a lot of it is wasted. Or it might be that I haven't trained my workers very well, and so they might make lots of mistakes, and that could cause lots of wastage. It could also be the other way round. I might actually have workers who demanded a higher wage, so maybe they realise that I'm actually asking more of them and they won't paid in accordance. Or maybe lots of workers have left, and the only workers that I can get in exchange to replace them are those that are highly technically trained, and so it's obviously I'm going to pay more for it. What do I always need to look at for evaluation in these questions? So remember, anything more than 10, we're going to look for evaluation. It could be discuss, it could be assess, to what extent. So what is the examiner's tip? Although the overall variance is positive, they should look closely at raw material costs and wages and salaries, as these are over budget. So just because I have a profit positive variance doesn't mean to say there shouldn't be anything for investigation. There may be a valid reason, such as the use of better quality materials. That would have increased my raw material costs, but the variance could indicate unnecessary spending in these areas. So you need to really go back and think, was there a lot of wastage? Does it say that my workers weren't very skilled? Have I maybe not got workers in the right place at the right time? Finally, they should look at sales revenue to see if the reason for the good performance of X could be applied to Y. So let's say, for instance, you've got a favourable sales variance. You need to see what caused the favourable sales variance, because if you could replicate that year on year or month on month, that would be really beneficial for your overall profit levels. Now, this might be something, I've called them X and Y, but that could be shop number 1 and shop number 2, or it could be this continent versus this continent. So because things are positive, you shouldn't just automatically assume that I'm not going to investigate them. We will want to investigate them, because to aim for the best is to look up to who has the most improved sales revenue, who has the best targets that are met, and benchmark against those. Just quickly to finish off then, even if the variance is positive, it could be of concern to managers. So why did they not anticipate it? Is it because the managers are not trained? Is there anything they can learn from this next time? Can it help empower these managers in order to set good targets for their team? And finally, the extent to which a variance causes concern depends on whether it's adverse and favourable and how big it is. If it's only a couple of pounds, maybe that won't be particularly bothersome. Maybe it'll be too cumbersome to investigate. But as soon as it reaches £100 or £1,000, then I think it's perhaps in the manager's best interest to work out why it occurred and learn from this in the past.